Hello and welcome to Market Domination. I'm Josh Lipton alongside Shauna Smith. In for Julie Hyman, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think it's a diversion. Number one, Boeing's having a hard enough time handling their own production. Buying back Spirit isn't a guarantee of nothing other than Boeing be managing it. It has to be more than that. Again, to charge Boeing with criminal malfeasance by the government is sort of like a fire alarm company suing a building for having had a fire. We're in a situation here where Spirit is Spirit, and there's no guarantee that Boeing will be able to manage it any better than they can manage their own operations.
The Supreme Court has said that the president does have absolute immunity from prosecution for official acts he conducts as president, but he has no immunity for unofficial acts. And the court is sending this case back to the trial court where this all began. And part of what they will have to do at that trial court is determine what is an official act and what is an unofficial act.
We all year have been penciling in about 2 rate cuts from the Fed. So we were way behind when the market was thinking there was going to be 6. And now we're thinking that, we're a big ahead of the game as the market's pondering whether there'll be any at all. I still think we're going to see the moderation in inflation necessary to get the Fed to those 1 or 2 rate cuts later this year.
We've got 1 hour to go until the market close. We're taking a look at some of the major averages here. We are trading just above the flat line. You've got the Dow essentially flat on the day, but you've got the S&P up just about 0.1%. Taking a look at today's trading action, really struggled for direction shortly after the open, although ever since just before noon, we have maintained some green here on the screen. Again, up just about 0.1% for the day. You've got the Nasdaq in leadership position here among the 3 major averages. That's up just about 0.6%. The real action, though, for today is going on in the bond market. And I want to take a look at the 10-year yield, because right now, when you take a look at that big number here, it's 4.48%. We're just below that 4.5%. Now, we have been pushing up against that, just 2 basis points below that threshold right there. That is something that traders, that Wall Street pros have been talking about all trading session. Now, Wall Street's starting to evaluate what exactly a Trump presidency, what exactly that means just in terms of spending, tax cuts. We're seeing that play out right now in the bond market. When you take a look at the dollar, we're also seeing that move higher here, up just about not too much here, just still below 106. But again, this trend to the upside, if we do see a Trump presidency, some of the action that we've seen over the last 2 trading days kind of points to the fact that we could see more gains here ahead. And then when I want to take a look at the oil market here, because we have seen some gains here today, a hurricane hitting the Caribbean here, and that's pushing crude prices higher. It's up just about 2% right now. Also, some geopolitical risk is playing into that move that we are seeing higher. And taking a look at the sector action here so far today, technology, consumer discretionary, that's really been the story throughout today's trading day. They are leading there. You've got industrials and materials lagging behind. And taking a look at some of the technology leadership that we are seeing play out within the market right now inside the Nasdaq 100, a lot of those larger cap tech names showing gains here today. You've got Apple up just over 2%. You got Amazon right around that level as well. And of course, big gains for Tesla as well. Well, the market's winding down the first trading day of the month, kicking off the second half of the year. Jared Blickery has a look here at how stocks tend to perform this month. Jared.
Well, thank you, Shauna. If you're into the NASDAQ, guess what? The NASDAQ has been up something like 10 of the last 11 years. But today we're going to focus on the S&P 500, which, by the way, was up 14.5% through last Friday. That's the first half of the year, and that's a material amount. Now, going back to 1928, there are 29 other years where the S&P 500 was able to mount gains of 10% or more. And I took a look at those, and you can see in the chart here, most of those outsized gains are concentrated concentrated in the beginning of the year, but not to be left out, we still have July. I'm trying to circle that right here. So July expected returns down to about 1% from maybe 3%, and those are just average returns. But we're also seeing the tendency to close green. That's closing down a little bit. So we're entering a little bit of a trepidatious part of the year. Now, Bank of America did their own study. They looked at the first 10 days and the last 10 days. These are trading days of the month. And what they found was July is actually, the first 10 days of July are the best time to be in the market in this specific method. And if you look here, you can see the end of September actually the worst. But just going back here to my original chart and kind of putting it together, looks like we might be in some, and we're just talking tailwinds here, but we might be in some gains for the next couple of weeks. But then those tailwinds, they kind of drop off, and we're not seeing any boost, at least by seasonality, until, guess what, right around November, just in time for the election, things pick up again. So that's the map that we're looking at here. But again, these are just tendencies.
All right, Jared, thank you. While investors prepare for hopefully another strong July ahead, focus still remains on the Fed and the path ahead for the second half of the year. And joining us now is Jim Schmigel, SEI Chief Investment Officer. Jim, great to see you.
Good to see you again, Josh. Shauna?
So we had maybe some big picture, Jim. We had, obviously strong first half. Yep. What are you telling your clients? Do you think the good times continue? Do we repeat this in the second half?
We're definitely letting them know that we think the economy has been much, much more resilient than we had expected. But we also are having them prepare for higher interest rates. We're seeing that today. This has been 2 pretty strong days. Obviously, a lot of that based maybe on the outcome of the last debate and what that portends for November. But our view has kind of always been, and this has been one of our biggest tactical positions this year, has been for higher 10-year rates. I mean, we see inflation being stickier than expectations. The Fed wants to cut. There's no doubt about that, whether or not they should or not, but we think we're only going to get one this year. And we think the 10-year does continue to drift, even drift back up to that 5% level. The bigger news last week, maybe even from a debt perspective, outside of the debate, was really the CBO report. So, we're going to add $400 billion to the debt. Since the February estimate, we're looking at 122% debt to GDP in the next 10 years, interest costs overtaking defense spending. The picture is not a pretty one, and supply and demand at some point is going to matter in the Treasury market.
Jim, when you talk about getting back potentially up to that 5% level, what does that timeline look like? How quickly do you think we could reapproach those levels?
We wouldn't be surprised to see that as we approach the end of the year. So the one wild card here is, what will the Fed do? We think we don't have enough time between now and July. July is off the table, and September might just be a little too close to the election. So again, they want to cut. Whether or not the data is going to allow them to do that remains to be seen. We'll get another picture of that this coming Friday with NFP. But this bear steepening that we've seen in the curve is something that we expect to continue. So this could definitely be, by the fourth quarter of this year, we're going to test those levels again.
Let me ask you, Jim, another earnings season fast approaching here, right? I'm just curious to get your take. When you look at earnings expectations, do they look achievable to you, Jim? Do they look lofty? How do you think about it?
I'll take the latter. They look a bit lofty, very optimistic. I think earnings season is going to be interesting from not necessarily do companies hit their numbers, but how they hit their numbers. Are we talking about, is this micromanagement? Is this expense management and buybacks to get to this number that the street has put on each individual company? Or are we actually seeing kind of organic growth? And outside of all that, we're really more interested in guidance than we are in kind of the earnings. Like how are companies seeing the next kind of 6 months of the year? How are they preparing? What do they see the economy on that kind of day-to-day basis? What does that mean for the consumer? What does that mean for the business environment? That's going to be the most interesting thing. But the bar is high. The bar is particularly high in mega tech. I mean, that's where it's very, very lofty.
So, Jim, my question to you, if you see yields potentially, the 10-year yield heading back to 5%, you talk about valuations right now, maybe some concerning trends just in terms of how high that bar is here for this upcoming earnings season. Where does that leave us with equities? And I guess how much volatility should investors then be bracing for?
Well, it's interesting because volatility is the key metric here. Index level volatility has been incredibly low.
Yeah.
We've been looking at 11 handles not that long ago, so a little bit higher today. Individual stock volatility, of course, is always going to be higher than the index level, but what's so unique is how high it is with the largest names in the index. If you look at the implied volatility of Nvidia, it's over 50. I mean, that's that is a really highly volatile name that just happens to be one of the largest companies in the entire world. So, I mean, our view on what we're telling investors is pretty basic at the end of the day, which is diversify away. Particularly if you're a passive investor, it's worth remembering you're a buyer at any price, and about 35 cents of every dollar you put into the market is going into 10 names. And thinking about that in a different way, maybe adding some active management, adding some differentiated beta approaches, equal weights or value indices, not a bad time to be doing that to kind of take some chips off the table with this very, very concentrated U.S. large cap market.
And Jim, you also, earlier you mentioned the presidential debate. I just want to get your take on, I mean, obviously, listen, we had the debate.
Yep.
Today we had the Supreme Court decision. How are you talking about this election to your clients? What kind of questions are you getting, and what are your answers?
Yeah, I think all of us in this business, when we talk about things like politics, we like to speak lightly. But so no doubt, look, the betting markets are what they are. We're pricing in a higher probability of not just a win for former President Trump, but really a Republican sweep. So now you're going to get tax cuts, you're going to get tariffs. What does that mean from an inflationary perspective? The one thing that we are reminding our investors of is that one way in which it doesn't really matter is the debt, right? No one's talking about fiscal responsibility. No one's talking about entitlement reform. So however we get to an increased debt level, whether it's through tax cuts or whether it's through additional spending, the reality is we're going to be looking at still a deluge of government debt coming down the pike. That's not changing regardless of what happens in November.
So then what does that mean for the economy? What does that mean then, more broadly speaking, for the markets, given that risk that appears to be an overhang?
We think it means a higher than what investors are used to terminal rate from the Federal Reserve, kind of a higher inflation rate than what investors have been used to in recent years. So that in our minds, that kind of plays into this kind of higher for longer type scenario. Because again, supply and demand does matter, and we're going to have a lot of supply. Whether or not all the same buyers are going to be there for the Treasury market kind of remains to be seen. We're skeptical of that.
All right, Jim, great to have you on set. Thanks for helping us kick off the show.
Thanks for having me.
We are just getting started here on Market Domination, and coming up, shares of Chewy on a wild ride after the influential meme stock trader known as Roaring Kitty revealed a stake in that company. We're going to speak to an analyst about what it means for the pet retailer.
And Tesla is set to report delivery numbers for the second quarter this week. Can it match the performance by some of its top Chinese competitors? Stay tuned. Much more of that and more. You're watching Market Domination. It's been a wild day for Chewy investors. Ahead of the open, Keith Gill, aka Roaring Kitty, disclosing he took a 6.6% stake in the company. And it comes after his tweet last week of just a dog, which drove shares higher. But we are seeing the stock well off those earlier highs, and now down just about 5.5%. Joining us now, we want to bring in David Bellinger. He is Mizuho's senior analyst. David, it's good to talk to you. So it certainly has been a wild couple of trading sessions here for Chewy. I'm curious from your perspective, obviously when you take a look at the trading patterns of Chewy leading up to this most recent news, it had been trading very differently than some of those other meme stock names. Is that now all about to change, or has it now changed because of the activity over the last several days?
Yeah, great. And thanks for having me on. Look, this is a very odd situation here, right? We don't think this is an optimal scenario for Chewy shares. And just taking a step back here, this is very much outside of the company's control, right? Senior management is doing a pretty good job of maintaining and managing the business going forward. But I think these developments that you've got here today, adding a lot of volatility to the stock, and from an institutional investor standpoint, I think this could create an impediment to owning shares, right? You're going to have Chewy now associated with these meme stocks. It's going to get grouped in with GameStop, AMC. We've all seen what happened to those names in the past. So I think from here on out, this excess level of volatility, this excess news flow, it's going to create a growing sensitivity to owning shares. We don't think that's a great development for Chewy.
David, I'm just curious, the meme stock sort of trade theme. I mean, I'll be honest, David, in 2021, I did not think, we'd be still talking about this in July 2024, but it seems like it's here in some form here to stay. I'm curious just how, if at all, David, it kind of just impacts and influences your job as a financial analyst.
It's a great question. I didn't think we'd be talking about this either. But for my view, we're looking at Chewy from a pure fundamental perspective. Right, and Chewy is a real company, right? You've got $11 billion of annual revenues. You've got 20 million active and loyal customers. Free cash flow is starting to turn positively for Chewy. It's starting to inflect higher. Our real concern with the stock has been that net active customer growth has stagnated. You've had 6 quarters in a row now with year-over-year active customer numbers down. That's been the big hesitation for us. Chewy operates in a great sector. We think that senior management's doing a good job. The sector overall has been challenged, though. You've got all these inflationary pressures. It's been holding back pet ownership and new adoptions. And we really think that's the key next catalyst for Chewy. But now with all this news flow that you've got here and trying to track data points across Reddit or Twitter or just somewhere else, it just adds a new layer of complexity to all this, one that we have to track. But I think from an institutional investor standpoint, it's very easy to just avoid this headache, right? You don't have to worry about this if you're not a holder, if you're not involved in some way. And I think if you're getting more and more of this news flow and more of this fever pitch picking up, that's going to make your typical institutional investor that much opposed to owning or selling the stock, and just taking more of a view of a neutral and standoffish kind of stance here.
Yeah, I'm curious if you could talk to us a little bit more, David, just about that fallout. You mentioned the potential shift that we could see in institutional investor involvement. Beyond that, how volatile could these next several trading sessions be as a result? And when you talk about the fact that it is trading now much more similar to a meme stock rather than to fundamentals, you talk about the movements that we could see on the back of earnings, things like that. How much of that is now discounted, do you think?
Yeah, it's highly, highly unpredictable. And for me to tell you what type of trading range Chewy will be in tomorrow or in the next few weeks is near impossible. But I think what you are going to start to see is the fundamentals start to be decoupled with the way in which the stock is trading, right? And some of these things like historical valuation parameters, maybe they get thrown out the window, right? It makes our job increasingly more difficult. So we are trying to look at this from a fundamental standpoint, if there's an opportunity in the stock. But in terms of day-to-day volatility, some of these squeezes higher, they screen as potentially good exit opportunities. You had a big #1 shareholder in Chewy, the private equity firm BC Partners. They're already selling their stake, right? Chewy bought $500 million worth of shares directly from them. There was a filing late last week that they used that meme strength later in in the period to sell additional shares, $155 million worth of shares according to that filing. So you may see more and more of this as the volatility plays out, but it's something to keep an eye on from the fundamental standpoint as well as just this day-to-day volatility.
Final question, David. And here's probably one you're more comfortable answering as a financial analyst. Just what are, you're on the sidelines, David. You got a neutral. What do you need to see? I mean, take Roaring Kitty out of it. What do you need to see here before you would be comfortable telling your clients, hey, listen, this one's a buy?
Yeah, absolutely. The number one element here and the number one catalyst is growing active customers in a sustainable way. Chewy went from about 13 million active customers in 2019. You had the whole pandemic surge, the shift to online spending. That number ratcheted up really quickly to about 20 million. We've sort of been stuck here, right? And the company has had some mixed guidance on when and just how quickly those numbers just start moving higher. The last earnings call with Q1 results, definitely a better than feared print. And you did have some green shoots coming out of adoption numbers starting to pick up, relinquishment data starting to get better on the pet side. But it was pretty clear to us that we can't fully underwrite this. One quarter doesn't make a full trend here. And I think you might see numbers from at least a pet sector begin to improve slightly. But with all these cumulative effects of inflation, just that clear path to a sustained upward move in active customers, especially for a growth stock like this, that's what's being held back in our view. And that's the next catalyst and the most consequential data point we're looking at from a fundamental perspective.
David, appreciate you coming on, talking all things Chewy and Roaring Kitty. We appreciate it.
Thank you.
Let's get to some trending tickers now. EV stocks trading higher today. It's after Chinese automakers reported better than expected deliveries for June. And Tesla also riding the rally as the company is preparing to announce delivery results tomorrow. So Tesla in the green here, Shauna. It did seem like, it was that news from Chinese EV makers, NIO and others. They reported some EV delivery data for June and Q2 is obviously well received. Of course, Tesla, as we said, they're going to be announcing their Q2 deliveries. It's not been an easy 2024 for Tesla. We know that. Stock's down about 15% so far this year. Though I will say Bloomberg pointing out the move here we're seeing, Shauna, marks fifth straight day of gains for Tesla, would be the longest winning streak in almost about a year.
Yeah, and it's trading back above its 200-day moving average, I believe, for the first time since January. So we talk about the sentiment shift maybe that we are seeing surrounding Tesla. You've got the news out from some of those Chinese EV makers earlier today. That's obviously adding to that bullish sentiment that has been surrounding Tesla as of late. Although I should caution that with, or maybe cushion that with the fact that many on the street are still a bit skeptical about what Tesla's quarters are going to look like, at least in the immediate term. When you talk about the fact that they've had to resort to price cuts just in order to boost demand, Wells Fargo was out with a note today saying that, hey, taking a look at the moves that we have seen in Tesla, it's really hard to argue that we are going to see a meaningful move to the upside when it comes to volumes. And they actually called out the fact that they expect to see, quote, diminished returns on some of those price cuts here. They expect the auto's gross margin ex credits to drop by 210 basis points on a year-over-year basis. So there's certainly a lot to be, I guess, maybe cautious of when it comes to Tesla in the near term when you take a look at just the fundamentals and what Wall Street is expecting. But despite that, you take a look at investor sentiment and they're still finding reasons to buy Tesla at these
You know who's not cautious long term? Dan
Elon.
Ives and Wedbush. Here's what he had to say. We believe the China growth piece, he's talking about Tesla's numbers that are coming in. We believe the China growth piece for Tesla is slowly turning around and saw a mini rebound in Q2, which should help Tesla come close, he says, to the street's 435,000 units estimate, still outperform target 275.
We'll see.
Bullish, Dan Ives.
But again, when we get those numbers later this week, we'll see what Wall Street's reaction is to that and exactly what the numbers are that Tesla puts out. All right, well, shares of Boeing on the rise today. The jet maker announcing that it will buy back supplier Spirit AeroSystems for $37.25 a share. The deal valued just around $4.7 billion. Now, they're doing this just about 20 years after the spin-off from Spirit AeroSystems here. So I think the question that Wall Street is asking right now is how much of an overhang maybe this removes when we talk about the turnaround picture that's taking place, or the turnaround story right now of Boeing, what Boeing needs to do in order to really regain some of that momentum, win back trust, not only of its customers who are flying on airplanes, but obviously the airlines themselves. Maybe this move is going to be enough here in order to regain some of that trust, get a little bit more of a better handle on the manufacturing side of things, and maybe eliminate some of the issues that have plagued Boeing here over the last several years. But again, analysts, at least early reaction, do remain cautious on what exactly or how big of a catalyst this is going to be for Boeing, at least in the media. I guess in the near term, near to medium term.
And on top of that, we had, so that's one headline. Then, I mean, there's a lot of Boeing headlines. We had a lot of, then we had reports, you saw, Sean, DOJ plans to charge Boeing with criminal fraud, finding the company violated a 2021 deferred prosecution agreement. This was tied to 2 previous fatal crashes. So a lot going on. And on top of all of that, of course, what you're wondering is who's actually going to be leading this company, because you have the CEO, Dave Calhoun. We know he's resigning at the end of the year, so who takes that big chair? You have heard folks kind of asking, could it be Pat Shanahan, CEO of Spirit AeroSystems? Is that the guy? We wait and see. Meanwhile, Cassava Sciences announcing today it's forming a committee to investigate 2 senior employees. This is coming days after a researcher connected to the company was indicted on fraud charges. That researcher allegedly submitting fake data to the National Institutes of Health related to an experimental Alzheimer's treatment. The stock was also temporarily halted Friday due to volatility after plummeting more than 40%. So this one it's a complicated one, Sean. I mean, Cassava is a small company. It's a market cap of around 600 million, but it was making headlines. And per reports, you did have this advisor to the company indicted by a jury. The allegation is submitting fabricated, falsified data to secure this, I guess, 16 million in grants from the National Institutes of Health. In a statement to the Journal, the company would say, listen, this person is no longer a paid advisor to the company, hasn't been involved in late-stage testing for this drug in question, but certainly getting a lot of attention.
It certainly is getting a lot of attention. Now, doubts surrounding this drug first started just about 3 years ago here, followed by that investigation by the SEC in November of 2021. So we have been talking about this now for a bit of time. Now, Cassava Sciences, to their defense, they added that this doctor had no involvement with the late-stage trial, so trying to reassure some of the skeptical investors out there just about the impact that maybe he had on some of those later stage trials here. But again, lots of uncertainty. They did also say that they terminated their consulting relationship with the doctor prior to his indictment, but clearly it's an overhang.
I reached out to the analyst at H.C. Wainwright because they cover the name. Bottom line, they did downgrade the stock to neutral. They did not assign a price target, telling their clients, here was the quote, we believe this controversy could be a significant long-term challenge to realizing upside in Cassava stock.
Certainly a top trending ticker here on Yahoo Finance today. Well, AI-related companies notching market cap wins in the first half of the year. Amazon, the latest to reach a milestone, hitting $2 trillion in market cap for the first time. This all while Apple, Microsoft, Nvidia battling it out for the title of the most valuable company. Here with more on what may be in store next for these mega cap names, we want to bring in Tom Forte. He's Maxim Group's managing director and senior consumer internet analyst. It's great to talk to you here. So here we are set up for the second half of the year. We certainly have seen this massive run up once again. I mean, the story is very similar going back to 2023. It's all about a handful of tech names. Who do you think then, Tom, is best positioned at this point here for the remainder of the year?
Yeah, so I like Amazon. So at some point, when you think about artificial intelligence, it's been dominated today by chips. But at some point, the chips or picks and shovels are going to have to result in actual gold. And I think for Amazon, they're well positioned to exploit AI, not just at the cloud computing level with what they're doing with AWS, but what they're doing at the fulfillment center level to the extent that they can increase their automation and reduce their cost to serve. So I think Amazon's well positioned in the battle of the AI titans.
Tom, when you think about Amazon, you think about these key drivers, right? It's e-commerce, it's cloud, it's advertising. Also, the moves they're making in healthcare, Tom, I'm interested to get your take there. How excited do you think investors should be about that opportunity?
So when I think about Amazon hitting $2 trillion market cap, I think there's an opportunity that their healthcare initiatives can help them hit the $3 trillion mark. More likely, it'll be, as you pointed out, advertising, e-commerce, cloud computing growth. I think they're very early stage in their efforts, but I do think there's a potential, given that it's a huge total addressable market and maybe one that's potentially ripe for disruption. But it's something that I guess I'm taking a wait and see attitude to see how their healthcare efforts ultimately affect their top and bottom line and market cap.
Tom, Amazon able to reach this milestone at a time here, obviously, when they're under a tremendous amount of scrutiny from an antitrust perspective. I'm curious, not only for Amazon, but really what we're seeing from a number of those larger cap tech names. Should investors be viewing any sort of regulatory crackdown or any sort of regulatory criticism here as just noise?
I think investors are viewing it as noise, but I don't think they should view it as noise. If I do a compare and contrast, though, on companies that are being sued for antitrust, I think Amazon is better positioned than Apple to the extent that if Amazon were separated into 3 different companies, a first-party retail company, a third-party retail company, and a cloud computing company, you can make an argument that those 3 individual stocks are worth more than the collective whole today. I don't think for Apple the same can be held true, meaning if the company is charging too much of a fee on the App Store and has to lower its fee, I think that would be, wildly negative for the stock.
Tom, sticking with Apple, I mean, it's had, I'm just looking, nice run here, Tom, recently. I mean, you're still neutral. What do you need to see, Tom, to get off the sidelines? What do you need to see to move to a buy on Apple?
So if you look at Apple, it has had a really nice run. First, they announced a $100 billion buyback. Then they announced Apple Intelligence and all their strategies surrounding AI. The stock, though, is trading at north of a 30 times forward PE multiple. If they do as well with an AI-led upgrade cycle for iPhones, we're looking at 9-10% EPS growth next year. That's still a pretty high PEG ratio of, call it, 3. So I'd be more interested in the stock where the valuation more to my liking, either because the earnings growth is better than I expect or the near-term multiple is lower than it is today.
Tom, what do you think that demand is going to look like? Obviously, we've been reacting to the news that we had gotten out a few weeks ago when it comes to their AI initiatives. Is that going to be enough, do you think, to really spark some of that demand that the street's been trying to figure out what more specifically that's going to look like?
So I have become more optimistic in an AI-led recycle for Apple. The challenge, though, we did some analysis when we compared it against 5G. I don't think there's nearly as much pent-up demand for an AI-enabled smartphone as there was for a 5G one. In addition, you're looking at Europe and China with regulatory challenges for Apple. Europe's about 20% of Apple's sales. China's about 10%. So they're not going to be able to roll out Apple Intelligence in September in those markets as of today. So I think it's an upgrade cycle, but not as good as the 5G upgrade cycle.
All right, Tom Forte, always great to have you. Thanks so much for making the time to join us here today.
Thank you.
Well, still to come, Morgan Stanley raising its price target on Nvidia. We will dive into the note and check in on some of today's top analyst calls when market domination returns.
Apple is launching its next generation AI-centric iPhone in September, but some analysts say the company's new Apple Intelligence platform may not be enough to spark sales in 2025. For more, we have Yahoo Finance's very own Dan Howley. Dan.
That's right. David Vaught at UBS Global Research is essentially saying that Huawei's push in China and its growth, resurgence really, after it was the U.S. tried to kneecap it in 2019, is really putting a governor on Apple's ability to grow in 2025, and that the Apple Intelligence platform may not be what it's not necessarily cracked up to be, but may not be the kind of offering that really pushes consumers to get out there and buy, similar to 5G. Obviously, we just heard Tom Forte talking about that a second ago, that 5G was really kind of a cycle change. We went from 4G LTE to 5G, faster speeds. I'll be honest with you, if I'm streaming stuff on my phone, I really don't see that much of a difference, but whatever. It was, cool marketing, I guess. Apple Intelligence is kind of a new means of getting people to buy smartphones. It's similar to what we're going to see from Google and their upcoming Pixel phones that they're going to launch in August, as well as from Samsung, which is going to announce new phones this month, actually. They're expected to announce new phones this coming next week. So we're expecting to hear more and more about AI, but with that, you would expect means more iPhone sales. According to David Vaught, though, it may not be this big push that Apple hopes it will be.
Yeah, so Jen, my question to you is they're up against some stiff competition. They also had the fact that in China, at least the consumer cooling just a bit. So what's the thought out there from the street as to what Apple needs to do in order to regain some of that lost momentum?
Well, they're trying to do that with steep cuts on prices, right? There's doing a lot of sales in China, trying to get more people involved. Obviously, earlier last week, Bloomberg had reported that there was a 40% jump in May iPhone sales in China after a 50% jump in sales in April. But there's mixed kind of messages out there. We saw Counterpoint Research, David Vaught actually citing it in his note, saying that sell-through was relatively low for Apple year over year. I think it was 9 basis points versus larger growth of, I believe, around 11% for the broader market in China when it comes to smartphone sales. So, Apple doesn't give us insight as far as the number of devices it actually sells. They stopped doing that a long time ago. So now it's basically best estimates as to what users are buying. And so, it could be that these sales are working. They're helping Apple, but it doesn't mean that Huawei is going to sit idly by and allow Apple to just, discount its phones and win in that way. So Huawei obviously doing similar things to its own credit. And then they're also rolling out foldable phones, which are larger in China. That's a market that's really kind of interested in those kinds of products, as well as some areas of Europe. I've seen a lot of people walking around recently with Samsung's foldables. And so in China, there are foldables from the likes of Huawei and Xiaomi and such. So that's kind of a means that Apple could use, perhaps a new form factor to get consumers more interested. I think generally it's about, they have 2 billion users right now, give or take. It's all about the software strategy and getting people hooked into subscriptions, which has been its kind of modus operandi for some time now.
All right, Dan Howley, great stuff. Thanks so much. Let's stick with tech and talk about Nvidia. It's time now for some of our calls of the day. Morgan Stanley raising its price target on Nvidia following positive data points and a compelling AI narrative, to put it in their words. Nvidia's price target now at $144 a share. That's up from $116 per share. All right, Josh, let's talk about why Morgan Stanley is raising its price target here when it comes to Nvidia. They're still very bullish here on this name, or bullish on this name, positive maybe is a better word, considering that their new price target's just about 17% higher from where the close was on Friday. But a couple of things. They just had a recent trip to Taiwan, a recent trip to China that they're saying left them very confident in their near-term numbers. They also were talking about the fact that that strong demand that they have seen has removed any concern, and that Morgan Stanley did previously have, about the pre-Blackwell pause. We know that that was something that was top of mind here for analysts heading into the last earnings print. A lot of that fear had been subsided, or at least eased just a bit by some of the commentary that we did get from Nvidia's executives on that call. But again, they're still finding reasons to say here that the catalyst path remains strong, and they're still positive, still bullish on where this name is going to head.
Yeah, so Morgan Stanley really likes Nvidia. Pretty much everyone on the street really likes Nvidia. Nearly 90% of analysts think you should buy it here, Sean, at these levels. There's exactly one sell on Nvidia. I like this line in particular. We aren't pounding the table at these levels, they say, given the sharp appreciation since the last earnings report. But this remains, the analyst says, the most compelling narrative in the AI semi space. We did get that, by the way, she mentioned that other headline we saw today, which French antitrust enforcers are getting ready to charge Nvidia with allegedly anti-competitive practices. That is per Reuters. We'll see how that one plays out. All right, moving on. Goldman Sachs kicking off its coverage on U.S. telecom services, names with a bullish tone. So here was they kind of initiate U.S. telecom services infrastructure sector. Their buy ratings, Sean, say reflect stocks where we believe the market does not fully appreciate the sustainability of growth the company can deliver across the cycle, or where the pace of potential cyclical recovery in fundamentals is being underpriced. So what are those names, Sean? They give you a few buy ratings according to Goldman. They would say Verizon, AT&T, Digital Realty, Equinix, T-Mobile, American Tower, and Frontier, all buys, according to Goldman.
Yeah, they're pretty bullish on the sector overall, just in terms of the opportunity, the growth opportunity that they do see for a number of these names. You got Verizon on your screen. They have a buy rating of $50 price target there. What also caught my attention was within this note, Goldman was naming some of the catalysts here just in terms of what they see driving some of these names higher. And they talked about AI, and they said that AI represents, quote, an important opportunity here for the sector. They also went on to say that they see this backdrop driving healthier growth margins, potentially here for significant capital returns, when they talk about the fact that both competitive intensity and capital intensity are moderating simultaneously. And they're doing that here, at least for what Goldman says is for the first time. So again, they're bullish on Verizon, like I just said. When you talk about AT&T, they're saying that some of their catalysts there, fiber broadband leadership, growth in wireless franchise, and then T-Mobile broadband driving that next chapter of growth.
They don't like everything, though. They don't like everything.
No, they don't.
We mentioned the cells. Charter Communications, Altice, Lumen Technologies. Goldman says no thanks. They're moving on.
You're going to leave us there on that?
Yeah.
Everyone's on the edge of their seats. We want to know why. All right, let's talk about travel stocks. They're sliding today as Hurricane Beryl hits the Caribbean. The Category 4 storm making landfall today, causing issues for cruises and for air travel. When you take a look at the travel stocks, almost everything seems to be in the red. We have a heat map there that will show you that has stocks under a tremendous amount of pressure today. But we got the cruise lines on your screen right now, and you're looking at pretty significant drops. Norwegian off just over 5.5%, Royal Caribbean off 1.5%. Now this coming simultaneously as you have the price of crude rising here on this threat of the hurricane, just exactly what the damage could look like, what exactly the threat here could be to the U.S. going forward, and then more specifically, how many delays or cancellations this is going to cause for so many of these travel names is the real reason why we have a tremendous amount of pressure on this sector today.
Yeah, Hurricane Beryl, I was reading reports today saying we could be looking at $1 billion in damages. And remember, what's interesting, Carnival only recently boosted its full-year earnings outlook. We talked about it on the show. The stock popped on that headline. I think there was some enthusiasm for that, what's said about demand. But you're right to point out, a number of names today did slip in today's trade on that. Coming up, streaming stocks are in focus for today's investor playbook. We're taking a look at which names are best positioned for the second half of 2024. That is next on Market Domination.
Paramount is searching for a streaming partner. That's according to a new report out from CNBC. Now, the entertainment giant is reportedly looking to merge its Paramount Plus service with another platform. The news coming after previous merger talks had failed to materialize in the first half of 2024. Now, with the second half of the year in focus, we are discussing how to navigate the big picture for streaming stocks more broadly with the Yahoo Finance Playbook. Now, joining us now, we have Jamie Lumley, a sector analyst at Third Bridge Group, and also Santosh Rao, head of research at Manhattan Venture Partners. Great to see both of you. Jamie, let me start with you. This new report that we're getting out here from CNBC, when we talk about the streaming space in the second half of 2024, I think a lot of people, their first thoughts is going to Paramount and exactly how that is going to play out. What do you think is the most likely option or end game here for Paramount at this point?
It's a really good question. And with Paramount, I mean, it's been a whirlwind of a year for them. It seems we have a different headline each week about what might be the future for this company. But if we think about the future of purely Paramount Plus and where they're at in streaming right now, a lot of people, when they hear Paramount Plus, it's not really on the top of their list of must-watch streaming platforms. In terms of its business fundamentals, it's at considerable scale. It's just up to 71 million subscribers, is making improvement on profitability. But it really hasn't gotten to the same size, the same profitability metrics like a Netflix or where Disney is now with their direct consumer business to really make it kind of a mainstay in that top tier of streaming players. So to think about what might be the future from them, they could look maybe at a Warner Brothers Discovery, perhaps a Max might be a good partnership to really build out the offering they have there, or perhaps a Peacock, because over at Comcast, they're still trying to figure out what the best route forward is for that platform. And together they might have a bit of a broader reach. But as we've seen for the last few months, nothing is set in stone for Paramount, and where they exactly end up is still anybody's guess.
Santosh, I want to bring you in here as well. Same question, Santosh. Paramount Plus, what do you see as the future there?
Yeah, I mean, this flows right into my theme that there is a transition going on and consolidation needs to happen. And this is the right thing to do. They're on their own. They're just not going to be able to make it. We have the undisputed champ, which is Netflix out there, and Disney behind them. So I think these companies need to consolidate, need to get together and put up a fight, so to speak. They're way behind. So you're going to see a lot of this. It is required. It's healthy for the sector. And I think you're going to see that. That's going to be the theme going forward as we move out of this kind of slump, so to speak, in the media space. We need to get out there and with a better alignment of companies in this space. Right now, there's not much scale in these two companies on their own.
JB, what do you think? Do you agree that consolidation essentially needs to happen? And is this potential Paramount outcome here, however, this ends up just the start of what is going to be a larger trend?
Well, it's interesting because there's been consolidation discussed for a while at this point. As we think over the last few years, this streaming space overall has lost billions and billions of dollars. And it's clear that while there might be some companies here which can reach profitability, it is unlikely that all of them will be able to rebuild these streaming companies or these streaming businesses to offset for the traditional media companies the declining revenue and earnings that they had on the traditional linear businesses. So if we look over at some of the smaller players, we could very well see some consolidation. But one thing which is interesting is before we talk really about consolidation, we're seeing a lot more of aggregation and just working together amongst these different platforms. We have lots of new bundles to talk about. We have Disney with Warner Brothers Discovery, Netflix with Comcast and Apple. There are different ways the industry is looking at building strong relationships with consumers and dealing with another real hurdle that these businesses have been facing, which is serial churning behavior by audiences. Once they are done with the platform, there's no qualms for most viewers of cutting their subscription and jumping to another one and then coming back when there's a new show they want to watch. So finding new ways to manage some of these viewership and just consumer behavior challenges is also something these businesses are trying to do while they sort out some of the larger issues of how they exactly either find a good partner from an M&A perspective or find a really good path forward to become profitable and also a strong business to offset the continuing declines in linear TV.
Santosh, it's interesting consolidation. I get the reasoning Santosh, because listen, streamers want to get profitable and linear TV is shrinking. And so you could certainly make the case strategically and financially, Santosh, but there are also challenges, right? Including most obviously the regulatory backdrop. Those trust busters in Washington have a much more skeptical eye toward consolidation, unless, Santosh, what you're saying is you're suggesting that maybe there's a change in the White House and the administration coming and we maybe get a more friendly regulatory backdrop.
Yeah, I think the consolidations that I'm talking about is not going to be a threat. There's not going to be a monopoly of such. It's sustainability. I mean, these companies will just not last. So I think it's going to be healthy for the industry, and the regulators are not against that. And they're not just against consolidation for the sake of being against it. There's a reason behind when they are against something. So in this case, I think it's a healthy thing. The consolidation needs to happen. There are many sectors. I've been following the telecom sector for a long time. I've been a telecom analyst, and I've seen a lot of acquisitions and M&A activity there. So there are areas where the regulators do agree. So all this is going to happen in the face of consumer is slowing down, consumer preferences are changing. So it's not just, there's not enough to go around. The consumer doesn't want, already the average consumer is spending about $60 on streaming services, according to one data from one of the services. So I think that has to come down. So the demand for all these services is going to come down. It's going to consolidate in few companies, good companies that have depth, had to have width, and have a global presence. So I think distributed presence. So I think you're going to see a lot of things playing out. Consolidation is the healthy part, but it's not just someone just taking out competition. It's increasing competition and making the competitive landscape much more healthier.
So Jamie, given the consolidation that maybe we could potentially see the changing dynamics within the streaming space, who do you view then as best positioned right now in streaming?
Well, for the players who are best positioned, they're likely the ones who probably don't need to do any consolidation. If we look at, there was just the Nielsen data shown right there, Netflix, Amazon, and Disney are all commanding very substantial numbers in terms of market share. And when we look at each of these players, Netflix, largest scale of any of the streaming platforms out there, they've already cracked the profitability piece. They continue to bring hits to their platform. Bridgerton's doing quite well right now. You know, if you think about where they are today, it's quite healthy as they continue to also build out other revenue drivers, such as their ad-supported tier. If you look over at Amazon, while they're dealing with certainly a different business model, they don't have to break even or be profitable within their streaming. They have this new, really exciting business with their introduction of ads, and combining that with their much stronger live sports segment too, there's a lot of opportunity over the next couple of years to drive growth. And Disney continues to really drive strong market share when it comes to viewing. So they definitely stand out in front of the pack today.
All right, Jamie, Santosh, great discussion, guys. Thank you both for joining the show.
Thank you.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
And that's the closing bell on Wall Street. And now it's market domination overtime. We're joined by Jared Blickreed to get you up to speed on the action from today's trade. Let's first, though, check out where we are closing the day. You've got the Nasdaq up just about 0.8%. That really was the driver here in today's action. A lot of that outperformance here in the market being driven by a lot of those larger cap tech names. You have the Dow closing up just about 50 points here, and you've got the S&P getting closer and closer to that 5,500 level, up just about 0.3%. Now let's head over to Jared for a closer look at some of today's sector action, Jared.
Yeah, Shauna, didn't see any record highs in any individual sectors, but I did see them in the Nasdaq Composite and a couple of individual issues. But first, let's take care of those sectors. XLK and XLY, those are the two outperformers. That would be tech and consumer discretionary. So really, those are mega cap featured sectors. And then also financials and energies in the green, but everything else in the red, led down by materials, down 1.5%, and industrials down just a little over 1%. And taking a look inside the Nasdaq, that's where we're seeing some of these records. I believe Microsoft and also Apple. Apple hasn't had a record high in a couple weeks. Both of those up more than 2%. You can throw Amazon in there as being up more than 2%, and also seeing some action from Tesla. That finally pushing above $200 per share, almost closing at $210 per share. So that's been one of those breakout moves that I've been looking for personally. And then looking at our leaders today, Bitcoin was actually the big leader. GBTC up 5% as a Bitcoin proxy. Also seeing New York FANG and ARK components in the green. ARK is at disruption play, so we'll take a look at that in a second. To the downside, home builders and solar, each of those down more than 2.5, at least those representative ETFs. And now here's a look at the ARK Innovation Holdings. I said it was a leader. A lot of that has to do with Tesla because that is the lion's share right there, but also seeing some strength in Coinbase and Roku. Josh.
Thank you, Jared. We are officially in the second half of the year, and markets kicking things off with modest gains. The Nasdaq, the top performer on the day. Joining us now is Brian Vendig, MJP Wealth Advisors Chief Investment Officer. Brian, it is good to see you. So we had a real strong start to the year, Brian. It sounds like what you're saying is, listen, stay positive, more good times ahead.
Well, Josh, I think over the balance of the year, I think that is our tone right now. And I think it's predicated on the fact that we're expecting earnings to continue to expand on a sequential basis. But as we know, this first half of the year was dominated by some of those Mag 5, Mag 7 names from last year continuing to lead the charge, especially if you break that down over the last 3 months, with 9 of the 11 sectors in the S&P 500 trailing our friends in technology and communication services, where most of those sectors were flat or to negative, slightly positive on an overall basis. Big disparity in returns. But I think that has an opportunity to change because as earnings expand from areas outside of mega cap tech, and we start to see continued confidence in that slowing inflation story with rate cuts being more and more a reality from September on, I think that's where you have a chance for a little catch up in the markets.
So, Brian, my question to you is, does today's action maybe point to the fact that maybe some of that is at risk when you take into account what maybe the market was pricing in today? Looks like it was more of a Trump presidency, some of the risks associated with that, just in terms of the spending, the tax cuts, and what ultimately that could do to inflation. And then, of course, the conclusion being what that means for the Fed. Is some of that, are you confident that this disinflation trend is going to remain intact, or how much of that is at risk right now?
Shauna, that's a great question. I think in the last couple of days, the bond market is telling us that with this higher probability or near-jerk reaction of Trump coming back to the White House, we saw rates go up in the bond market with those concerns based on fiscal policy adding to inflation and the economy moving forward. But I'm looking at things from a let's get to the election first perspective, because as we know, it's really difficult to handicap politics. And so when you break that down, the consumer part of the story is what's really been driving inflation and sticking on that stickier side. And so with a slowing consumer, slower spending, we've seen, and we're going to get the JOLTS number tomorrow, we've seen less job openings, less leapfrogging with wage inflation, and also housing prices sticky, yes, but with demand supply and a little bit of a freeze there because rates are still high, we expect some of that data to change as real market data is showing up in the government inflation numbers. So we still feel confident that over the second half of the year, inflation will come down, rates will come down. The Fed has signaled that they want to cut rates, but they're playing the wait and see game because no one really knows. But at the end of the day, I think we're seeing some disinflation in the system, and we're seeing the expectation of better earnings. And that's why our tone is positive for the second half.
And Brian, do you think the market needs the Fed to cut in order to keep moving higher here? Or is it just, no, the market just needs to think Jay Powell wants to cut, is looking to cut?
That's a great point. I mean, I think right now the market is looking for clarity of policy. I think when you're dealing with the uncertainty, that's what's really holding back on business leaders and some other decisions to be made on where capital is going to be allocated. But I think right now the market is still having a pretty high probability for at least one rate cut in September. I think the futures market there is saying around 60%, and a higher probability has ticked up in December. So we're still in the camp of 1 to 2 cuts, assuming that disinflation story creeping through over the summer months into the fall. And I think that's going to help the cyclical parts of the market. To go back to your question, the last couple of days when the rates going up, is it a surprise that the cyclical parts of the market, like industrials, basic materials, take a little bit of a pause while technology keeps showing their leadership? We think not. I think if we get a little bit more confidence that Fed policy is going to be there for cuts, that's where we'll see the cyclical part of the market have a chance to rebound, and that might even play into the small cap market as well.
I was going to say, Brian, so given that, what are you seeing in terms of the opportunity maybe within small caps and then even mid caps as well, given those expectations?
Yeah, Shauna, I mean, that's where, just big picture, value paired with growth has been our theme for investors over the course of the year, and staying diversified. And I think when you break that down, you don't have to pay 30 times plus forward PE like we're seeing in some of these mega cap tech names to get growth. I mean, think about industrials with this rise of infrastructure spending that's still going to play out over the next 9 years, and data centers and other areas of making our grid smarter, healthcare, M&A transactions, innovation, new therapies coming out. And small caps have always been disproportionately punished. And that's been going on since March of 23, when we had 2 bank failures and people were concerned about a recession and rates and what's going to happen to smaller companies. Well, yes, they still need to play catch up, but from a reality point of view, they're usually the ones that price the bad news first, and then and knowing that that's behind us, then they're the ones that come out of those situations to actually bounce back first. And I think we saw that in the fourth quarter last year. And I think, Shauna, there's an opportunity for that to play out when there's more certainty around that Fed policy measures on rates, as I said before.
Brian, as you look for opportunities, do you want to stay U.S. focused, or do you see any opportunities overseas as well?
That's a great question, Josh. I think, we definitely we do have some exposure in international equities, but we're leaning more in the developed part of Europe and Japan. But our bias has been more focused domestically here in the U.S. And that's just because of concerns with changes in the dollar, as well as just recognizing some of these political uncertainties that keep coming up with policy, as we saw over the weekend with things going on in France, and also a little bit of the start-stop and what's going on in China. So right now we're leading more domestic, but we're playing a close eye on where the dollar is going to move post-election as we get a little bit more clarity on policy, both from a tariff as well as foreign policy perspective.
All right, Brian, great insight there. Thanks so much for joining us here today.
Thank you both.
Well, the Supreme Court ruling former President Donald Trump has some immunity from criminal charges related to his attempts to reverse the 2020 election results. This partial backing of the former president will delay any trial on the matter. Joining us now for more at Yahoo Finance's Rick Newman. Rick, it's good to see you. So certainly I think a lot of people are trying to figure out exactly what this means. Maybe what is the impact or implications here on former President Trump's campaign for the 2024 election. What can you tell us?
Very hard to tell on a bank shot basis how this affects Trump in the 2024 election. I guess it means that we are not going to have this trial completed, this Washington, D.C. trial completed by the time of the election. I think that was considered a long shot anyway, just by the fact that when the Supreme Court took up this question, it delayed those proceedings by several months. So it looks like what is going to happen is it is going to go back to the judge in the Washington, D.C. court, and she will probably get started pretty quickly. But she has also said that once she got a ruling from the Supreme Court, she would give both sides time to prepare. And what they now need to do is go through the charges in this case one at a time and see, well, given what the Supreme Court said, do these charges now no longer apply? Because this is something, yes, the president is immune from prosecution for, and that probably will be the case. So what's probably going to happen here is the prosecutors are going to have to winnow down the charges to maybe just one or two charges. It would have to clearly be stuff that happened outside of what you would consider Trump's presidential duties. And then once they get to that point, even then, Trump can appeal it again to the Supreme Court. So he's going to run out the clock on this one in terms of the 2024 election. I think it's very hard to tell, in what other way this might affect what's happening in the campaign. I mean, I think the political system is frankly on overload right now. Democrats are still trying to figure out what to do about Joe Biden's terrible performance in the debate last Thursday. Should he stay in the race? Apparently, the family says he's staying in. A lot of Democrats seem to be saying, we're not so sure about that. What are our options here? So that's going to take time to play out. And by the way, barely anybody knows today, Steve Bannon went to jail. This was Trump's former campaign advisor in 2016. So yet another Trump person, somebody from Trump world, headed to prison, but so far not Trump himself.
Rick, what did you make, if anything, of the 6-3 split on the court with his decision?
It was very predictable because it was the six conservatives saying the Trump president, well, not the Trump presidency, it's the presidency has more power than anybody really ever thought before. At least they made that clear. It was sort of predictable. I mean, I thought it's not automatically obvious that just because you are a conservative judge that you think that the president should be more able rather than less to get away with something that might be criminal while he's serving as president. I mean, there used to be law and order Republicans who were really tough on crime, including crime committed by public officials, which presumably includes a president. So one thing that I think people should keep in mind is this is a finding about the powers of the president, whoever the president is. And it happens to be in a case involving Trump. But guess what? It also applies to Joe Biden, who's the current president. It is possible Donald Trump will never be president again if that's what voters decide this year. And this will not apply to anything Trump might do as president, but it might apply to, it clearly applies to future presidents. So I think there's a chance this could unravel in ways that are different from a lot of the reactions you're seeing today.
All right, Rick, always great to have you on the show, my friend. Thanks for joining us.
See you guys.
Bitcoin down more than 9% over the past 3 months as spot ETF enthusiasm wanes, but could the cryptocurrency be in for a near-term rebound? More market domination over time. Coming right up.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance. Bitcoin regaining some momentum to start the second half of the year with prices up just about 2% today. Now the move higher following a downbeat quarter for the cryptocurrency, still off about 12% from its March high as investors' excitement surrounding Bitcoin ETFs had cooled. So what can investors expect in the second half of the year? Here to help us answer that question and more, we want to bring in Ben McMillan, Chief Investment Officer at IDX Advisors. Ben, it's good to see you. So here we are kicking off the second half of the year for crypto. I think lots of people are at home questioning whether or not we are going to see this return of excitement when it comes to the crypto market, more specifically Bitcoin. What's it going to take in order to regain some of that momentum?
Well, I mean, we do have a couple of near-term catalysts to look forward to. The first of which is being the presumption of spot Ethereum ETFs that could really come as early as this week. We've seen a lot of excitement about that, especially as kind of adoption of the crypto market starts to broaden. I think the spot ETFs did a really good job of kind of, for lack of a better term, mainstreaming the idea of Bitcoin to a broader audience that, probably wouldn't have really thought about it otherwise. We've been hearing those conversations with, in conversations with advisors and institutional investors that we talk to, that once the BlackRock ETF all of a sudden came onto the marketplace, they're starting to, consider it more closely for their, so-called 60-40 portfolios. But I do think a lot is going to depend on the macro in Q3. Bitcoin is, for better or for worse, highly correlated with the Nasdaq. It looks and feels a lot like a very, high beta growth stock. And, to the extent that we see, the emergence of a U.S. recession, even if it's shallow, and we do start to see a rotation out of, higher beta, tech type stocks, I do think that could weigh on Bitcoin.
But I also want to get your take on a different topic. I don't know if you saw this, but billionaire Peter Thiel was on another network recently, and he was talking about Bitcoin. And it was interesting, Ben, just because he didn't sound as enthusiastic as maybe a lot of people would imagine. He still acknowledged, listen, he holds some Bitcoin, but he said he isn't sure the price will rise dramatically from here. I was just curious, Ben, what, if anything, you made of those comments? Do those comments matter, Ben?
I saw that as well. I found it interesting because it's hard to not be kind of structurally bullish on crypto in general at this point in the cycle. It's still very early from an adoption rate. It's still very early, too, in terms of use cases. A lot of what we've seen is just kind of scratching the surface in terms of, what crypto can do in terms of facilitating, real world outcomes. We saw a glimmer of it with kind of DeFi Summer, Web3. The idea of kind of smart contracts and things like ordinals kind of, branching out into the broader world. So, it's hard to see how this is kind of the end of the run for Bitcoin. I just don't see it. Now, that's not to say there's not going to be volatility ahead. And again, Bitcoin is going to go where the macro environment goes. So I do think it's important to be cautious for investors that it's, just because the secular bull story or thesis is intact doesn't mean it's going to be a straight shot upwards. But I'm hard pressed to believe that, Bitcoin doesn't set new highs over the next, 12 to 24 months from here.
Ben, you just mentioned that correlation a couple of times here, just in terms of what we've seen with some of those more risk-on assets and the price of Bitcoin. When you take a look at that correlation, does that make sense, given some of the activity that we had seen prior to the last 12 months? And I guess drawing from that, what does that then tell us maybe about what that activity could or should maybe potentially look like here in the coming months?
Yeah, that's an excellent question. And it's one where, we were very reticent. Kind of, if you look at the correlation of Bitcoin to stocks in general, or tech stocks in particular, it was very low kind of pre-COVID. And then after COVID, particularly after, quote unquote, money printing, you saw that correlation spike. And that makes a ton of sense. We think that's here to stay. Now, that doesn't necessarily mean it's going to be as high as it has been recently forever. It's running at kind of a, 0.6 correlation. But we're not going to go back to the days of Bitcoin being, zero or even negatively correlated to risk assets. So, investors need to understand that positive correlation to risk assets of Bitcoin is here to stay. It's something to, it's something to factor in when you think about it within your portfolios. But that also doesn't mean that it's not at times, going to move a little bit differently, or that it doesn't have, any diversification advantages. But I do think, again, we always caution investors, think about Bitcoin as a very high beta, high duration or long duration kind of tech play. And, in the context of your portfolios, because that correlation, is going to ebb and flow kind of around the 0.5, 0.6 mark, but it's not going to go back to zero. It's certainly not going to go back negative, not with, any kind of long-term structural outcome. So I think, think of it like a high beta tech stock.
Ben, are you surprised the way crypto has become an issue in this presidential election? And do you think, Ben, there's a candidate, Biden or Trump, who's going to have an easier time winning over that crypto crowd?
Well, yeah, I mean, what's been interesting to me in this election cycle is the degree to which the crypto PACs came out in force with real big money, and they've been influencing outcomes already in kind of, congressional races. We saw the one in the Bronx, there was a big one in California, and, the crypto PAC, Fairshake and some other ones, spent real money backing crypto favorable candidates. And so I think what's interesting there is crypto now is all of a sudden, kind of a force to be reckoned with. And I think politicians are taking note on both sides of the aisle. I also think the crypto community, by and large, is favorable to a Trump outcome. Trump, I think, has been strategic about trying to court the crypto community, saying, he's going to do a lot of great things for crypto. But I think even if you heavily discount that, just the fact that it's probably at a minimum going to be much more laissez-faire than what we've seen with, a Biden administration is what's driving a lot of the crypto enthusiasm for Trump. But yeah, I mean, I think the bigger takeaway, at least to me, has been how active and how big the kind of crypto lobby has become this election cycle. And I think that's here to stay as well, too.
Yeah, Ben, talk to us a little bit more just about the significance of that and the influence maybe you see that having just more broadly here beyond the election.
Well, yeah, I mean, it's interesting because I think it's going to force a little bit more thoughtful narrative. And I think I have to say, I think the crypto lobby has done a very good job of, being very clear that, listen, this is a source of innovation for America. And so, we're not asking for any kind of special treatment. We're just simply asking for, lawmakers and politicians to, look at crypto as a technology, as a source of innovation, and not just kind of cast it out as the domain of illicit, criminals and money launderers and things like that, which is kind of the early narrative or early rhetoric we heard from, some Congress people, a couple of years ago. And so I think it's come from a good place. I think it makes a lot of sense. And I think it is actually having an impact in terms of educating Congress people and politicians. And let's also not forget, record amounts of people own crypto. If you look at the estimates, it's upwards of 60 million people. So it's not a fringe thing anymore. It affects a lot of Americans. People are paying close attention, especially as you look at things as, federally backed CBDCs and potential privacy concerns around there. It's starting to occupy very real mind share for a lot of Americans.
Ben, great to have you on the show. Thanks for taking the time to chat today.
Absolutely. Thanks.
Time now for what to watch. Tuesday, July 2nd, Tesla is reporting deliveries for the second quarter. Analysts expecting the company's deliveries to fall. Another drop would be the first time deliveries for Tesla have dropped for 2 straight quarters. It's coming after Chinese EV rivals, including NIO and Li Auto, reported better than expected deliveries on Monday.
Moving on to the Fed, Fed Chair Jerome Powell is speaking at the European Central Bank Forum in Portugal in the morning. This coming after a round of Fed commentary on Friday. Now, San Francisco Fed President Mary Daly saying that recent inflation data indicates monetary policy is working. But she also says that it's too early to tell when to cut rates.
And finally, the monthly JOLTS report. That's the job openings and labor turnover survey for May coming out in the morning. Economists forecasting that number to tick down to just under 8 million. The new job data tomorrow giving us more insight into the health of the labor force and coming ahead of Friday's full jobs report.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern Time for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The second half is underway. Stocks closing out the day higher to kick off the third quarter with the tech-heavy Nasdaq leading gains and closing at a new record. We're going to take a closer look at what's next for artificial intelligence in 2024. Plus, speed bumps on the path to electrification. U.S. automakers are scaling back investments in electric vehicles as demand falls behind expected levels of growth. Drivers are concerned about cost, charging, and range. We'll talk with one company helping to assuage some of those fears. And investors await Friday's crucial jobs report this holiday shortened trading week. After a string of encouraging inflation data, the market is on alert for signs of weakness in the labor market in hopes of achieving a soft landing. Electric vehicle enthusiasm is stalling out here. Over the past few months, car makers like GM and Ford have pivoted or scaled back their EV production plans as demand proves weaker than forecasted. For more on the EV market, we have Gene Berdichevsky, co-founder and CEO of TSLA, a battery manufacturer that aims to improve the safety, charging performance, and life cycle of EV batteries. Gene, it is great to have you on the show. And I want to maybe start big picture, Gene, as we sort of hinted there. You know, you look at EV sales growth, Gene, it is not what it once was. I'm interested to get your take on why you think that is and what's going to jumpstart it from here.
I think we're seeing a slowdown because EVs are just not meeting all of the mainstream consumer adoption expectations. So what consumers really want to see is longer range, faster recharge time. I think we've been very, very focused on cost as the primary driver, and now you have EVs that are quite well priced. But we need to continue to improve performance as well as the charging infrastructure. I do think that this is a temporary slowdown in adoption. This isn't a change in direction. All the automakers still agree that electric is the future. The question is, it may take a year or two longer to get there.
Gene, one skeptical take I heard, and I want to get your take on this. You'll hear people say, you know, that big bump we saw with EV growth, that was first movers, that was first adopters. Now they've come and gone, and growth ahead just won't look like that again. What's your response to that?
I think that was first adopters, but those first adopters are also the leaders in a trend. And at some point, EVs are going to hit the performance marks that consumers across the board expect, and we're going to continue to grow. Think of that as the first people that bought an iPhone were also early adopters. It was expensive at the time. You know, it was a little bit better than what was before, but that began, a product evolution that consumers ultimately got behind. And I think we're going to see the same thing here. We're going to have better EVs coming on the market in the next few years, and that'll reignite and reaccelerate the growth.
Gene, so let's pivot. Let's talk about your startup, TSLA. What are you all trying to do there? As I understand it, you know, the mission here is to help EVs kind of drive farther, charge faster.
That's right. So we make a silicon material that boosts the performance of today's lithium-ion batteries. We're able to deliver about 20 to 25% more range in the same volume and weight of a battery pack. So imagine any of the EVs that you're looking at today having 20-25% more range just with a chemistry upgrade. We're also able to drive down recharge times. Ultimately, we believe we can cut the recharge time in half, and that would obviously be a very big deal. And longer term, as we get to large scale production, we'll also drive down the cost of the battery pack, which of course still remains an important consumer consideration. So we're really working to address all three of those things, range, recharge time, and cost for consumers.
Is there, Gene, right now, is there a meaningful difference in cost right now between your batteries and those traditional rechargeable batteries?
Our technology has a very small cost premium today. We're still at an emerging company. We're still at small scale. And so we're tending to go after higher end vehicles. Our first announced customer was Mercedes, and their plans are to launch us in their electric G-Class vehicle to start, but then we all certainly want to move downstream to broader markets. And so we're working through that. We have a roadmap for that. And then our second announced partner was Panasonic. So again, we're starting at the higher end, and then we'll work towards mass market vehicles in the coming years.
And what is broadly, Gene, kind of the broader market for EV batteries like right now? You know, how healthy How resilient is it? And I'm also interested just geopolitically, Gene, who dominates that market? Who leads it? Is it the US or is it China?
It's definitely China-led right now, and I think that there's a huge concentration there. And it's
why
Asia-led.
is that, Gene? Why is that?
Low cost of production, and also just historically, that's where a lot of batteries have been produced. Korea and Japan also do very well, and that's where really the industry was for consumer electronics batteries, and so the EV battery industry grew up out of that. So the U.S. is playing catch up because we never had a battery industry in consumer electronics, and the Asian countries had a 30-year head start. So it's not just China, it's also Korea, it's also Japan. What the U.S. has an opportunity to do is really lead with new technologies like sealess. So rather than playing catch up, trying to make the exact same battery that is being produced in China, using new technology, next generation chemistry, next generation performance, that's really where the U.S. can lead.
Gene, really interesting discussion. Thank you for taking the time to hop on the show today. Appreciate it.
Thanks for having me on.
U.S. stocks closing higher to kick off the second half of the year. Investors beginning to count down to the key U.S. jobs report. Yahoo Finance's very own Josh Schaefer joins us now with more of the trading day takeaways. Josh.
Yeah, Josh, the Nasdaq Composite hitting a record high today, despite a higher move in the 10-year Treasury yield. And that's going to be my first takeaway today that I want to take a closer look at here. So I want to pull up that chart of the 10-year, and we saw a pretty significant move in the 10-year Treasury. So you see there up about 14 basis points. Typically over the last, we'll call it a year or so now, at least it's been that long, if not longer. As yields have gone up this much in a day, normally you've seen stocks go down. I'll take a look at a 3-month chart here for us, and we can look at April. If you remember April, we had that big chug higher. That's when we had a 5% pullback in the S&P, right? So it's interesting for me to see that move higher in the 10-year today, but not really see it in stocks. So if we take a look sort of what the market looked like today, I think this is kind of intuitive for what this move really means for investors, right? As yields go higher, you see kind of this move to quality is what strategists often call it, right? Look at our top two sectors there. Tech, consumer discretionary, right? And so, tech mainly is what I'm highlighting there. And what's interesting within that is you look at what succeeded today. You had Microsoft close at an all-time high, Amazon up 2%, Apple at an all-time high. So as we get closer to 4.5% on the 10-year, strategists basically circle a couple big companies and say good earners are going to be what can do well in that environment, but anything other than that, and you start to struggle a little bit. And that, I guess, the broad takeaway being as the 10-year moves higher, we might not get that broadening out that people want to see.
Is that, and you mentioned 4.5, is that sort of the level, you know?
Yeah, I would say 4.5.
Is that kind of the level folks are watching?
Yeah, so when you take a look at the 10-year, we're close to 4.5 right now. 4.5 is kind of when people start to really go up in quality. This is per Piper Sandler's Michael Kantrowitz. He highlights 4.5 as kind of a key level. And then if you get below 4 to 4.5, maybe companies that are just good earners can do well. If you get below 4, then you get kind of the small cap broadening rally. So really, I think this is going to be important to watch because we had this big move up, and you have that jobs report on Friday, and we know that usually moves yields a decent amount. So that'll be something to watch.
Schaefer, takeaway number 2.
Takeaway number 2. GDP forecasts keep falling. And this was not the story to start the year, right? And it was not the story of 2023. We talked a lot about GDP forecasts keep going higher. The economy is doing better than expected. Well, let's take a look at the Atlanta Fed's GDP Now forecaster. This is for second quarter, and this went through all out the quarter. Look at where we're down here now. We're down below 2% for the first time for the Atlanta Fed GDP Now of the quarter. This takes in real-time data. And then when you look at just consensus compiled by Bloomberg, this is via UBS, we're at 2.3%. You can see here what I was talking about. We kind of came all the way up, right? This was the expectation. Now we're starting to come down a little bit. And I think that's just an interesting picture of how people are feeling about economic growth right now. We went from, are we growing too fast, to, okay, maybe it's going to be a little bit less than expected.
And so economy cooling, inflation moderating. What do you, I mean, some implications for the Fed, do you think?
That's soft landing, right?
Starts looking more reasonable.
Yeah, I think that's soft landing. And I think that's important to remember. Like 2.3% is still good. That's still about on trend with where you'd want to be. So it's not necessarily bad to see these starting to come down. Remember, when we were coming up like this and we didn't know where we were going to stop, we were talking about no landing. The economy's too hot. That's a concern for inflation. The Fed's not going to cut it all. So I think this is part of the reason you're starting to see 2 cuts priced into the market. And that's maybe where we land here on kind of what the takeaway is for now. The concern would be if it keeps coming down, but We don't know if it's coming down too far yet, so we're going to hold it there for now.
Schaefer, takeaway, meme stocks.
The fun one of the day.
Favorite.
The fun one of the day, right? So Keith Gill, Roaring Kitty, had an SEC filing out today that he now owns over 6.6% of Chewy. That is the pet care provider. This is not GameStop, so a little bit of a different look from him there. And Josh, really my highlight from this one, in his SEC filing, you can kind of fill in a box and put in whatever you want to some extent. He decided to put in a box here that says, check the appropriate box to designate whether you are a cat. Keith Gill confirmed he is.
Are you allowed to do that? I guess you are.
I asked our Jared Blicker, our markets
what did Jared
reporter.
say?
Jared said there is a box within the SEC filing that you can essentially enter like a text box and sort of put in whatever you want. And it seems like
and
Mr.
Keith
Gill
went for it. Mr. Gill went for it.
He went for it there. I thought it was interesting overall in the Chewy story today to just see shares decline throughout the day after that. And you look at this filing closer, he owned the shares last Monday. Remember, he tweeted on Thursday. It doesn't seem like the internet was too happy with the fact that he already owned the shares, then started tweeting, then it jumps. He's facing a class action lawsuit for what happened with GameStop. People starting to question whether Keith Gill might be operating some level of a pump and dump here. Those are just accusations to this point, but it doesn't seem like the retail crowd is necessarily following him and staying like they were on some of the other trades.
We had a financial analyst who covers Chewy on the show today, and it was interesting. I mean, listen, he's studying fundamentals, but it was interesting to get his take about how, listen, you get a news flow like this, and you get headlines like this, and you get moves like this in the stock. He thinks it just becomes potentially a lot harder for at least institutional investors to get comfortable with this. In other words, a lot of them he thinks are going to say, who needs this?
Well, Chewy is a lot more of a real fundamental story than GameStop too, right? And I think that's maybe to the detriment of the company here in some ways to get this sort of thing involved when they actually have earnings were up last quarter. They have kind of a positive fundamental story going with them. GameStop, I think, maybe a little bit less.
I mean, you're
so.
CEO, CFO, you can control a lot of things. It's tough to control Roaring Kitty.
Yeah, you don't know what meme he's going to put out, right? And then all of a sudden your stock starts going wild.
Joshua, thank you. Great stuff. The first half of the year was all about AI, so where does that tech head in the months ahead? We're asking for a trend on the other side. The rapid rise of artificial intelligence providing a lift for chip providers, according to Global X. By the end of this decade, a compound annual growth rate of over 30% is expected for annual spending growth on AI chips. However, semiconductor makers, not the only ones standing to benefit from the AI surge. Tejas Desai, Global X Assistant Vice President and Research Analyst, joins me now. Tejas, it is great to have you on the show. Let me ask you, when you talk about AI, Tejas, here, it is one of, maybe the hottest trend in investing. Traders, investors, they want to learn about it, study it, they want to find ways to play it. Do you think all this enthusiasm, Tejas, does it make sense to you, or do you think we've gotten a little bit ahead of ourselves here?
Absolutely, Josh, great to be here. I think we look at this as a moment of mass disruption when it comes to sort of the impact that artificial intelligence will broadly have on the global economy. In fact, this is very much like the internet itself. Enables new experiences and new products and services to be built here. And currently, we are in that infrastructure build-out phase, in that semiconductor opportunity, and that has, I think, worked very well for investors across the board for the last 12 months or so. A large part of it has been driven by Nvidia and a few select stocks here and there, but we expect an aggressive broadening out as that investment, as that dollar into this foundational sort of infrastructure goes about. And I think this is really a good time to think about the gains that you've had. For example, if you've been exposed to Nvidia, if you've been exposed to some of these names, and even the big tech universe across the board, and really start to think about where else do I find this growth for the next 18 to 24 months. And this is large majority of the conversations that we're having with our clients as well. And when you look at the universe, we're generally recommending that investors look at three specific areas, especially as they think about this next lap of growth with AI. Number one is obviously data centers and the entire digital infrastructure value chain, right? It's not just about building these massive, gigantic processing facilities, but also really closing the loop in terms of bringing these experiences to end users as AI use cases expand. Secondly, we encourage investors pay some attention to cloud software, cloud applications, cloud infrastructure, as well as areas such as cybersecurity, which appear very attractive. And if you don't want to play this from a technology standpoint, then you should certainly be looking at energy, uranium, copper, as well as a few other sort of areas there, especially as this power-hungry dynamic forms for artificial intelligence across the board. But a very investable theme here, even in the second half of this year, even though we've seen a tremendous rally so far this year.
So Tejas, let's get some picks here. Let's say data center. Your clients come to you, they want ways to play that. What do you tell them?
Absolutely. Look, our approach is, it's too early to have one or two picks to go with this particular theme. It's going to be a very secular build out. If you look at the computing infrastructure that we have currently around the world that is powering the global digital economy, we're really talking about at least $1 trillion worth of infrastructure, right? Chips, networking solutions, a lot of memory storage that is housed in these massive, gigantic, hyperscale processing facilities around the world. So our approach really is take a very passive approach. We, for example, have a data center and digital infrastructure ETF that has been picking up a lot of conversations across the board as well. But what we anticipate is a secular build out that will result in capacity expansion, and that will also likely translate in an opportunity for a lot of these data center companies, as well as companies that provide the components that go into these data centers, an opportunity to really grow their earnings at a much faster rate than what the market has baked into right now.
Copper, now that's interesting, Tejas. Why is copper a way to play the AI theme? And if you're interested, how do you play that? Do you just buy the red metal?
Absolutely. So, copper generally is very well correlated with economic expansion. So essentially, if you're building gigantic data center capacity, if you're building data center facilities, right, if you're also, again, we have electrification of automobiles on the horizon, or generally just an infrastructure upgrade that is currently playing into the fold. We're investing in power grids, we're investing in transmission facilities. All of that requires copper fundamentally, which really positions that, that commodity in a very good position here. We've seen copper price prices on a secular uptick for a while now. Prices have certainly pulled back, and I think that presents an interesting dynamic for investors to consider the commodity as a whole. Again, we offer a copper miners ETF here by the ticker of COPX. But that has been a very popular product for us so far this year as well. But generally, we're seeing alongside copper, conversations pick up in uranium and some of the other commodity offerings that we present here as well. So again, right, I think this is a perfect time to sort of take a step back. If you have been riding this AI momentum in the markets on the back of Nvidia, on the back of some of these big tech names, to really take a step back and think, where else do I position to find this growth opportunity? And there are many undervalued areas that we think investors should look at.
Tejas, great chat, interesting picks and strategies. Thanks for joining us.
Absolutely. Thank you.
Coming up, Friday's jobs report will deliver a crucial read on the state of the labor market. More asking for a trend on the other side. It's official. Six Flags and Cedar Fair have completed an $8 billion merger after announcing plans to combine last year. Earlier today, City Leisure and Travel analyst James Hardiman joined Wealth to discuss the merger.
This is far and away the biggest deal, really the only deal of its kind this century. And I think it creates significant value. You talked about, what success looks like. We think that value is created here, because there's a significant management upgrade, right? The Cedar Fair management team is the steady hand that I think these Six Flags assets have needed for so long and has been missing.
The new company, Six Flag Entertainment Corporation, will start trading Tuesday under Cedar Fair's ticker symbol FUN. While non-farm payrolls are growing steadily, household employment is sliding. Yahoo Finance's Shauna Smith joins me now with a closer look. Shauna.
Hey there, Josh. All right, so this is a trend that has certainly been capturing Wall Street's attention over the most recent months. So we wanted to break down exactly what we have seen from the most recent reports and then ultimately what that could potentially tell us about what is happening in the U.S. economy at this juncture. So what you have on the screen right here, this is the trend that we've seen in non-farm payrolls. Now, they have continued to grow, remain steady, especially when you compare to the historical average. The numbers that we have gotten most recently really point to a jobs market here that remains strong. Now, I want to compare that to the trend that we have seen in the household employment survey. So as you can see, that's the light blue line here, and that has been declining as the non-farm payrolls, which is a survey here of businesses, has been holding steady. Now, it is important to point out that the household employment survey here, that brighter blue line here on the screen, it is a smaller pool in terms of what the survey is, who the survey is asking, and they are also surveying households there. So lots of questions just about which indicator is more important or maybe more reliable here in the longer term. But I want to talk about the gap that we are seeing here, because the gap in the most recent report did widen just a bit. And this was really what the reaction was on the street to that last print. And what this chart really breaks down is maybe the theory behind why this is happening. And there was a new note out from Alpine Research really pointing, or Alpine Macro, excuse me, really pointing to the fact that maybe some of this has to do with immigration. We certainly have seen a surge in immigration over the last several years. And when you take a look at, it's estimated about 4 million undocumented immigrants right now live in the U.S. So Alpine Macro was pointing to the fact that if just under half of the undocumented immigrants are actually working, that would actually drop or account for about half of the discrepancy that we're seeing between these two charts. And I want to point this out because this is also something that big banks like Morgan Stanley, when you take a look at Goldman, when you take a look at JP Morgan, have been calling out just this gap that we've been seeing in the household and the non-farm payroll survey, and exactly what this signals and why this is happening. That key question, why? So some of that now being pointed to, maybe immigration is having an outsized effect or impact on that, and maybe that's why we're seeing these two readings remain so far apart at this point in the economic cycle, Josh.
All right, big number coming Friday morning. Thank you, Shauna. That is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.